Welcome to the Deep Dive, prepared by QIP Capital. Today, we're diving into a number you see, well, pretty much everywhere when you look at stocks.
Yeah.
The price-to-earnings ratio.
The PE ratio, yeah. It's definitely out there.
Exactly. So our mission today is to really unpack this thing. What is it, really? And maybe more importantly, what's it actually telling you? Let's get into the source material.
Absolutely. So at its core, the PE ratio is, well, it's a valuation tool. Simple idea, really.
Sure.
You just take the company's current stock price and divide it by its earnings per share, usually over the last 12 months.
Earnings per share, EPS.
Yep.
That's the total profit divided by the number of shares.
That's the one. So this PE number, it gives you a quick snapshot. How much are investors, willing to pay for each dollar the company earns?
Right, like a multiple. So say a $30 stock price, $2 earnings per share. That's a PE of 15. Investors are paying 15 times earnings.
Exactly.
And the material mentioned there's more than one type. It's not just one single PE number.
That's right. The most common one you'll see is the trailing PE. That uses the earnings that already happened, the past ones.
Okay, backward looking.
But then you've got the forward PE.
Right.
And that one uses analyst forecasts for future earnings. So it's about expectations.
Ah, so that's where hope or maybe pessimism comes in.
Precisely. And there are others too, like relative PE, which is all about comparing a company's PE to, say, its own history or its industry peers. It adds that layer of context.
Context, yeah, that seems absolutely critical here.
Yeah.
Because you see that PE of 15. Is that good? Is it bad? How are you supposed to know just from the number?
You can't really, and that's the crucial point.
Yeah.
A high PE, well, it often suggests investors are optimistic. Maybe they expect strong growth ahead, so they pay a premium.
Okay.
A low PE might mean it's undervalued, or maybe the company's got real problems. You absolutely cannot judge it in a vacuum.
So like a PE of 30 could be perfectly fine, maybe even cheap, for some fast-growing tech company, but totally outrageous for, I don't know, a stable utility company.
Exactly right, because the growth profiles, the business models themselves, they're just worlds apart. That's why PE is most useful when you're comparing companies within the same industry.
Apples to apples.
Pretty much. It helps you quickly see how peers stack up against each other, valuation-wise, relative to their earnings.
Okay, so it's a screening tool, comparison tool mainly within sectors. What else can it help investors figure out?
Well, beyond just comparing companies right now, you can look at a single company's PE over time. Has it gone up, down? That can tell you something about changing market sentiment or maybe shifting growth prospects.
Ah, see how it trends.
Yeah. And benchmarking it against, say, the S&P 500 average PE or its industry average, that also gives you a feel for whether it's generally seen as expensive or cheap compared to the broader market or its specific group. It's just a fast way to narrow things down or get a sense of the market mood.
But like any single number, it can't be perfect. What are the blind spots? Where does the PE ratio fall short?
Oh yeah, definite limitations. Big one first. If a company has negative earnings, PE is useless. You can't divide by zero, right? And a negative PE doesn't really mean anything useful for comparison.
Right, throws the whole thing off.
Totally. It also doesn't explicitly tell you about growth rates. A high PE for a company growing earnings at, say, 20% a year means something very different than the same PE for one growing at 2%.
You need that extra piece of info.
You really do. And another thing is accounting. Sometimes companies can use accounting methods, perfectly legally, that might inflate earnings temporarily. That makes the PE look better than maybe the underlying business really is.
Ah, so it can be potentially misleading if you don't dig deeper.
Yeah.
And it also completely ignores stuff like debt, right, or cash flow, which seem pretty important.
Crucial stuff, exactly. It doesn't look at the balance sheet strength or how much actual cash the business is generating. That's why the sources really stress, it's a starting point. A filter. You have to use it alongside other metrics, debt levels, cash flow statements, profit margins, to get a genuinely full picture.
Got it. So useful for a quick check, especially comparing within an industry, but definitely not the whole story. Okay, quick shift. What about something totally different, like cryptocurrency? Does PE even make sense there?
Generally, no, not in the traditional sense, because, well, cryptocurrencies don't usually generate earnings like a company does from its business operations. PE is fundamentally tied to that idea of profit.
No profits?
No PE, basically. Although what's kind of interesting is in some corners of DeFi, decentralized finance, where platforms might earn fees or revenue, There are some experimental attempts to create similar metrics, like price relative to protocol earnings or something.
Ah, okay. Trying to adapt the idea.
Yeah, but it's very early days for that sort of thing, and it's definitely not the standard PE we talk about with stocks. So really, to sum it up, the PE ratio is this core metric, gives you a quick read on how the market values a company's earnings power. Great for comparing similar companies.
Right, a powerful first look, especially for those comparisons within an industry, like we said. But, and there's the big but, it's only one piece. Doesn't work for negative earnings, doesn't automatically account for growth differences, ignores debt, ignores cash flow. You absolutely need other data points.
And thinking about crypto just highlights how it's really built for traditional businesses with earnings.
So if context and using it with other info is key for PE, here's something maybe to think about.
Yeah.
What other common financial numbers, other ratios maybe might you be looking at right now without really considering all the necessary context? And thinking about what the sources said, beyond just debt and cash flow, what else should you always be looking at alongside PE to get that complete picture? Something to mull over. Thanks for joining us for this deep dive.